Hi folks, I'm moving house today, so I'm going to do a pretty quick video for you, but I'm going to make some notes in advance of this video. These are for myself, but I might include them in the video. I'm going to talk about stocks, first of all, the pros and cons for a rally or a drop in stocks, and we'll look at the same thing on the dollar and the same thing on NATGAS and other commodities. Starting with the dollar overall, because that's kind of the basis for everything. We've seen the dollar drop through major support. I put some tweets up on this, you can have a look at that. Dollar has dropped through the 100 level. It's a pretty key support level. It's really important that we see that there's significant dollar weakness. So that's going to affect everything. The reason for dollar weakness is I think there's been money supply that we've not been told about in terms of infrastructure development and supplying munitions and support to the war in other parts of the world and all over the show. And I think there's been a lot of money printing. You can see it on the charts that we're not being told about, we're not aware of. You can see the effect on the dollar. Dollar has dropped down through key support, this level here, which is held for months and months and months. This is a weekly chart. And going back to the beginning of 2023, we've held above there twice actually. Third time broke through. That's a very bearish sign on the US dollar. Lower highs on the weekly chart and a breakdown 3 times. Not a charm, very often, as I always say. I think we'll get a little rebound in the dollar and then back down again. So this dollar index fall is going to affect everything. We're going to see potential increases in stock prices, and we're going to see potential reversals in commodities and all that sort of thing. Sorry to interrupt very briefly. If you don't like this video and subscribe to the channel and share it with your friends, this video will self-destruct in about 5 seconds. You won't be able to watch the rest. Thanks. Back to the video. First of all, before the dollar carries on down, and I think we're going down to this level here, which is at around about 98.2. That's the 61.8% retracement of the entire move up from the bottom to the top. That's around about 98. I think we'll bounce back up to the underside of 100 first. Back up to this 50% Fibonacci level that we hold above 3 times and then move down. I circled that there. So in the short term, I think we could see the dollar recover a little bit and then move back down again. Let's look at the pros and the cons for stocks. So going across to the stock markets, let's get there quickly. Couple of very interesting things on stocks. First of all, I want to point out this thing on the NASDAQ and S&P, actually 2 of them. We'll look at individual stock names a little bit later on. NASDAQ, you can see we've broken through the 78.6% Fibonacci level up into this pink level. And this pink level is denoted by at the bottom the 78.6 and at the top that sort of high there. This is the NASDAQ day chart. And if we compare this to what happened in 2008, and I've got to switch charts for this because I can't see it on this chart going back that far. And let's have a look at NASDAQ 100. This one here, this is the black bull chart, and I've drawn the same things on here going back to 2008. My charts are taking so long to load. Anyway, if you look at what's going on, okay, here we go. Anyway, you can see it on the tweet I put up here, over here. 2008, this is going back to 2008. We had exactly the same picture. Little high there, creating a new high, move down, double bottom, move up through the 78.6% Fibonacci, up to that level there on the left, and then a 15% drop back down to the 200-period moving average, and the top of the 61.8% Fib. Here, 2023, exactly the same. Sorry about the noise going on in the background. We are moving house, so it's going to be a bit chaotic. Move up. Exactly the same. Look at these 2 charts. They're almost identical. Move up to there. That's that pink zone. Move up through there. Back down. Double bottom. Move back up above the 78.6% and then into this pink zone. And then that's where we are right now. We haven't moved down from there. We're still right at the top. On this occasion, we dropped down 15%. And off chart, you can't see it. We rallied up to very significant new high, all-time highs after this. So that was a brief dip of 15% before a carry on, before a resumption of this rally. I think we're going to probably see the same sort of thing. I'm hoping for a drop down from this level here right now on NASDAQ, and then for a move back up into this level, break through it, up through the all-time high, the current all-time high, and then higher on the NASDAQ before a dramatic move down a bit later on. So that's stocks. That's what I think is going to happen on stocks. A lot of that's going to be driven by money supply and the dollar weakening. So there are pros and cons in terms of this. So overall, generally in the stock market, we've got AI hype, we've got chip stock hype, we've got extreme bullishness, optimism in the market, extreme, the fear and greed index is in its extreme. The market's on the go. It's risk off, everything's going into the market, everyone's bullish. Potential increase in money supply, and very, very importantly, the Fed potentially dropping rates. Probably not this year, but possibly into next year quite soon. We saw inflation coming down to 3%, a really, really low number, lower than expected, lower than previous, heading down towards that 2% level. Lower inflation rates means potentially reduce interest rates. So lower inflation rates mean potentially reduce interest rates, and that's what the market loves. Low interest rates, dollar down, markets to the moon, and the same thing goes for gold and crypto, Bitcoin, and various commodities as well. So that's the way I see it. The risk on this is that we're at this kind of very hyped up level right now. Let's see if we can go back to that chart. Still waiting for this to load. My internet's very slow. The risk for the markets is that we've got extreme bullishness, extreme fear and greed. We've got, we're incredibly overextended. The market's due a pullback. There are economic risks going on with potential recession coming up, and we've got this hyped up bubble type market moving up to this very, very key technical level, which I showed you here, this one here, which is an important study because we are exactly where we are in 2008, now 2023, almost identical charts. The fact that they're identical means that we may not actually get a stop here, and that everyone's seen the same thing on their own charts, and the market's just going to push right through it. However, there is a small chance that this will actually replay itself. It is a very key level. Look how far above the 200 period moving average we are right now compared to where we were during that period. We were just a smidgen above it. Right now, we're miles and miles and miles above the 200 period moving average, and we're going to have a pullback. So the risk to the downside remains there, even though I think we're going to be bullish and we're going to move up through this level and we're going to go to new all-time highs. That's what I'm thinking right now. Right back in February this year, I was saying this is a potential possibility. Everyone thought I was mad. Still think it's a possibility, but I think we could do with a pullback right now, at least to the 20 period moving average on the day chart. Let's just get a pullback to the 20. That's way down here at this level here, at this pink 50% Fibonacci retracement level and this previous high. Now that level there is at, let's see if we can zoom without my charts working, that level there is at about 13,500. So could we get a pullback down to about 13,500? That would be a 15% pullback, and it would take us down to this 120 period moving average, back down 15%, closer to the 200 moving average. This pullback here, even though it looks small by comparison, was also 15%. So there is downside risk to the market, and the fact that everyone's bullish, every man and his dog and his pig are to the moon on stocks, that's very bad and very dangerous for stocks overall. But at the same time, we've got money supply increasing, we've got this bullish hype, we've got AI hype, a bubble rally going on, and so on. So that's where I see it. I think we could get a pullback from where we are right now. We're short on NASDAQ, short in S&P, pullback maybe 10 to 15%, and then back up through this level, and then through the all-time highs, the current all-time highs, to new levels. That's what I think we're going to see on stocks. Now let's have a look at the dollar index. And yeah, so before we do that, here's the chart. This is going back to 2008. Finally, my charts have loaded. See what happens here. Exactly the same thing if you compare it to where we are today. There's that little high. Here's the thing there. Sort of spike high, drop down, double bottom, move up through the pink zone, through the 78.6, 15% pullback. And look what happened after that. That's where we are right now. We're there in that spot there. But just zoom into that. Let me just show you. So that's where we are at the moment right now on the NASDAQ chart. And look what happened after that. 15% pullback, very volatile, very messy. Remember, we've got interest rate decisions coming up. We've got all sorts of things that are going to affect the market. We've got economic indicators coming out. There's potential recession coming up. There's going to be a lot of jitters. And there are all sorts of unforeseen risks, of course, as well. We've got the Ukraine thing going on. We've got recession potentially in Europe. We've still got very sticky inflation in Europe. We've got all sorts of factors going into this market, which we cannot measure, we can't foresee, we can't comprehend right now. Perhaps some of that, we know what happened in 2008. And the subsequent recovery, and then a lot of messing around in 2010 before this carry on up to where we are at the moment. And this is where we are now. If I just scoot right across, you can see exactly the same thing. I haven't got these fibs drawn on here, but there we are. There's that pink zone, if you can imagine it. We're right at the top of that right now, where that spike high is and so on. And, well, we saw what happened last time. 15% pullback, and then a huge rally through to significantly higher highs. So that's what we see on stocks. So there are downside and upside risks on stock markets. When it comes to gold, I think we're going to get a pullback in the dollar, a little bit of strength in the dollar. I think the dollar is going to carry on weakening, as we saw earlier on. So we're probably going to see gold coming off a little bit, moving back down to retest some of these support levels on gold, and then a move down. We're actually long on gold after a breakup, and we started buying near the bottom here. There's a chance that we could retest this bottom if the dollar sort of picks up a bit of strength. We get a double bottom, something like that. Or there's a potential chance we go lower on gold. I don't think so at this stage. Gold has been the laggard. It hasn't been very good compared to the other metals. See, all the other metals have outperformed gold, including even copper. We've got platinum, palladium, uranium, which we were long on. We got out of uranium. And we were long on silver. We got out of silver too early. And silver has been the superstar so far. We got out really at the top of this candle, and we've seen another day yesterday of another big move higher, all the way up to about 20, or close to 25 on silver. I think we'll see a bit of a pullback on all these metals as the dollar strengthens a wee bit, and then we'll see those carry on. And then natural gas, the same sort of thing. whilst all the other commodities were rallying, natural gas did not. That's interesting and concerning. I'm going to do a separate video on natural gas, so we'll cover that. But we're biased long. We've got a hedge position, slightly long on natural gas. I've got 50% long, 75% long actually, 25% short, so net 50% of my desired position long at the support level here. And it's where the 200 period moving averages on the 4-hour chart. It's previous support. It's definitely a key level. It's the 61.8 pullback. We've got the 50 below us down at 240, and we've got 225 and 215 below us as well, which we could get to, especially if we see dollar strength. The fact that natural gas didn't rally along with the other commodities, it's the only commodity that didn't rally. Bitcoin also a bit slow, but some of the other cryptos rallied quite beautifully. Bitcoin was a bit slow, did show some strength, but not natural gas. In fact, natural gas sold off during this period of dollar strength, which is interesting because it should naturally kind of strengthen as the dollar weakens, but it has not. So if the dollar does carry on strengthening, pull back a little bit, not carry on strengthening, pull back, and then continue to weaken and then pull back first, we could see natural gas falling down to the next support level at around 235 to 240, and there's this rising channel line at the bottom underneath us. That could be too tempting for natural gas to get down there, but I'll do a separate video on that one. And that's all I wanted to say on that, really. These are just still notes to myself. The yen pairs. So I think, let's go to the euro. So we saw this massive rally. These are day charts, euro and pound, massive drop off in the dollar yen, massive rally in the euro and the pound. I think this is the biggest rally in the pound in several years, moving up. I think we've got a long way to go on these. I think we're going to see euro closer to 1.15 at some stage. I've got a downward trend line on euro. If my charts would just refresh, coming down in at about that level. There it is there, actually down at 1.16. By the time we get there, however, we'd be down here somewhere if we sort of faff around, pull back down to the support possibly if the dollar strengthens a little bit. So we could get euro dropping down to 1.095, 1.1, and then bouncing off that previous high, very significant double top sort of high. We've broken through it. I think a pullback to 1.1 and then a rally up to eventually 1.15, which would take us up to this red previous resistance line and also this downward trend line. If I put this on a weekly chart, you'll see it. Sorry about the scrambled, messy video, but just pretend I'm talking to you on a live broadcast, live stream. So I'm not even going to bother to really edit it. Probably I just want to get it out. So there's this the weekly chart. There's the downward trend line on the euro. We've reached it several, every time the euro drops, it comes back to that trend line. There's no reason to think it won't do it this time. So, it's just a continuous, steady downward trend line on the euro. And by the time, if we get up there, we'll probably meet it somewhere around where this red line is. This red line could go actually a little bit higher up to those spikes there. So let's draw that at the extreme. That's at about 1.16. Let's say it's 1.16. I'd rather draw a zone there actually and just put a rectangle from 1.16-ish down to 1.15. Something like that. So that's the target zone for the euro, and by the time we get there, we'll also hit this downward trend line. I think that trend line's too tempting for us to resist. So I see euro pulling back down to 1.1 now, with a bit of dollar strength, just rebounding. We saw the dollar index. We could just get back up to that 100 level, just below it, on a bounce back in the dollar. That'll force the euro and the pound and all the other currencies down before a resumption. So 1.1 and then 1.15 to 1.16 on the euro. And I think all the other major currencies will go with it, except I want to talk about the dollar yen and the euro yen and the pound yen and all the other yen pairs. And we'll have a look at this 4-hour chart. I think rather than dollar weakness, general dollar weakness going into the other major currencies like the euro and the pound and Canadian dollar, Swiss franc, etc. I think that dollar weakness will flow into yen strength rather than euro strength, pound strength, etc. I think the Japanese yen will be the main beneficiary of dollar weakness. So I think we're going to see dollar weakness and yen strength, but generalized yen strength. So in other words, instead of flowing solely into the euro and the pound, everything like that, I think we're going to see a lot of it flowing into the yen. There are a number of reasons for that, but we don't have time to cover that now. That means that we're going to see the yen strengthen against the euro, the pound, the Australian dollar, the Swiss franc. We've taken some good profits on all of these in the short direction recently, just over the last week or two. All of these have come down dramatically. We've been short all of these. We've now exited most of these. We're still short some of them, but not nearly as much. And I've now just hedged on dollar yen and looking for a move back up to about 140 on dollar yen, maybe 141 on dollar yen before a resumption of the move down. I think all of these will bounce up a little bit as we see the dollar just gain a wee bit. And then I think overall, there's some downside, quite a lot of downside to the euro yen, pound yen, Aussie yen, Swiss yen. And as I said, I think that dollar weakness is going to flow into yen strength rather than euro and the pound and the CAD and the Swiss and Aussie dollar, etc. I think that's going to be the play, and I still favor selling all of these on this screen that you see in front of you on rallies. We've already started selling Swiss yen and Aussie yen, and we'll start to look at selling dollar yen again, and CAD yen, and eventually euro yen and pound yen. So that's the overall play on the crosses, on the yen crosses, considering that we're looking for dollar weakness, but that weakness flowing into Japanese yen rather than the other majors. So that's that. And then, so when it comes to stocks, I showed you the stock charts. So there we are. We're at the top of that pink zone in NASDAQ. And I think really we're having a bash at shorts here. So 15% pullback would take us down to somewhere around here. 13.5. I don't know if we'll get that low even. We might, but I think we could get at least down to around 14.5, maybe 13.8. 13.8 is a very key number if you go back in time. Got some good support levels beneath us. So could we get a pullback down to 14.5, 13.8, somewhere around there on NASDAQ? The same thing applies to S&P. We're short on S&P as well, and we're prepared to stop these out and hedge them. Let me just be this is not set in concrete play. This is potentially a risky play going against the overall bullish move. But remember the downside risks that I talked about. And the upside risk is that an awful lot of short interest is flowing into the options market on stocks overall. So a lot of people are buying options to the short side, and those have to be covered with hedges in the spot and futures prices to the upside. So there's a lot of buying of spot prices in stocks and indices, and also futures in stocks and indices to offset the downside risk of those short options. I'm not an options trader, but when you buy puts, you're betting on the market moving down, and in order to hedge that risk, people are buying stocks, market makers. The risk associated with the puts on the options market. I hope I've got all that right. I'm really not an options trader. Anyway, so there's a lot of buying of stocks to hedge the upside risk on the downside plays on the options market. So that's what a lot of that's driving this market up. But here's the S&P moving up into that trend line. Same sort of thing. We got this 78.6% above us. We haven't actually touched the 786, unlike the NASDAQ, which has gone through it into the pink zone. On S&P, the pink zone is actually below the 78.6, which makes it more appealing actually, because we don't have to break that key Fibonacci level to get into the pink zone. The pink zone is below the key Fib level, and it's also below this trend line. And we've now sold right in the middle of this level here. Actually, we're not quite short yet. Our short price, our short entry on this is at 45.20. And we got up to 45. Did we get up to 45? We got up to 45.19. We might just take the short where we are at the moment. We might have, hopefully we haven't missed it again. But there we go. That's the picture on S&P. If we get a 15% pullback in NASDAQ, we might get a 5 or a 10% pullback in S&P down to some of these support levels here. Perhaps this blue zone at around 43, maybe even down to 4,200. So that's S&P. And then I guess these stock names will have to go with it. We're trying a little short on NVIDIA with quite a tight stop loss, and we're prepared to hedge that one if need be at about $465. So we're short at exactly where we are at the moment with a hedge actually just a few dollars below us at the moment because we moved up in pre-market, and with a hedge or a stop loss, depending on how you play it, at 465. And Apple, we've got short position on Apple, looking for that to move down, but we'll have to see how the overall market goes. If the dollar does strengthen today, it's Friday, it's the end of the week, could it be a free fall Friday? I don't know. If the dollar strengthens today, recovers a bit, pulls back to that 100 level or just below it, we could see some pullback in stock markets. And maybe for short-term traders, today is a good day to trade short on stocks. I don't know. Or we could just smash up higher and end the week on a triumphant, magnificent note with the magnificent 7 leading away. That's the overall summary. So I think there are upside and downside risks on the stock market. I think the dollar is going to strengthen a bit and then carry on moving lower. And I think the dollar weakness overall is going to flow into the yen pairs and natural gas. I'll talk about another time. But I think the fact that natural gas has not strengthened along with dollar weakness is a sign that we could see it moving lower going forward. However, we are long on natural gas, looking for a move up from this, but only 50% long. Still got some more to add if we moved lower. I'm hoping we do get a lower price on natural gas because I'd like to buy some more. WTI last quickly before I go. Sugar and soya we're looking to sell into rallies, but I'm not sure if we get those this week. I don't think so. And then WTI, we've hit, this is crude oil WTI, West Texas intermediary. We've hit the 200-day moving average. That's this purple line. A little bit overbought, quite a good move up. We've been long on this, but we got out sort of 3/4 of the way up near the top of this level here at around $73.5, $74. It's now gone up to 76 something, but we have hit the 200 period moving average on the day chart. There's a couple of trend lines above us. This green one's sort of pretty close, and then the longer term red one is somewhat further up. We could move up there, I don't know, but we are at the 200-day moving average. If we see a little bit of dollar strength, we could see WTI coming back in a little bit. Have a fantastic trading day on Friday, the 14th of July. Next time I speak to you will be from our new house. Show what my new office looks like when I get there this weekend or on Monday. If you like this, please subscribe and share and like and all that sort of thing as well.